Okay, and welcome back, students who are taking financial accounting, and we're working on the series of theory videos for Chapter 3, Adjusting and Closing Entries, and we're going to pick up right where we left off with one exception. Okay, so let me erase some of this here, and let's see, so kind of notice I keep on coming back to this so that you know where you're at in the process. And again, the details in the process are another thing, but you have to kind of understand the overall process. So where we had left off in the previous video was we had made adjusting journal entries, correcting entries to correct any mistakes, and adjusting entries to adjust accounts so that we have the correct balances in the accounts. And we posted those entries to our general ledger accounts, and we created a new adjusted trial balance. Okay, so that's where we had left off in the previous video, but now we're going, the next step in the process here is step 6, which is creating our financial statements from the adjusted trial balance. All right, so let me jump down there. Worksheet. Okay, so here's our worksheet, and again, this was not in the textbook, and watch the previous videos in order to understand why I'm looking at this here worksheet. So we had our trial balance, we made adjustments, then we did the math on our worksheet to have our balances in the accounts, into the general ledger accounts, and we use those in order to check the adjusted trial balance that we get from the bookkeeper, all right, or whoever's doing the bookkeeping, by either manually on paper or by using a computer system. So we're going to double check those figures, what they come up with what is on this worksheet, in order to make sure that they're correct. And when we're completely satisfied, then we can take those numbers, okay, from our adjusted trial balance, and we can begin creating our financial statements and our income statement, our balance sheet, and so on and so forth. Okay, so let's see here. So that's where we're at here. We had just created our adjusted trial balance. Now, from the adjusted trial balance, we can create the financial statements. So we're going to use these balances, all right, in order to do that. But realize that there is a twist to this. It's not a simple copy and paste. 95% of it is just copy and paste and putting it in the correct spot. I mean, like for example, we know assets, our asset accounts here, our liability accounts, our equity accounts go on the balance sheet. And we know that our revenues and our expenses go on the income statement. However, our retained earnings account is not going to be correct until we actually go through what's called a closing process. So what I'm getting at here is that we can take these figures from the adjusted trial balance, and for the most part, with the exception of this dividends account and this retained earnings account, we can use that same information to create our financial statements, but we're going to have to make some slight tweaking when we do that. Now, if you're using the worksheet, okay, and I realize you don't have it in textbook and you don't have to be able to see all of the information here, okay? But what I want you to understand is that when we have our adjusted trial balance, okay, our debits equal our credits, okay? Our debits equal our credits. But when we move the information over to the income statement, well, now all of a sudden debits no longer equal credits. Why? Because there's only, we can't control, you're not controlling what information goes there. So debits no longer equal credits. And the same thing with the balance sheet, footing. Debits no longer equal credits. I mean, if you go back to the very first set of videos, chapter 1 videos, or more importantly in those other introductory videos, I had said when you have assets equal liabilities plus equity, if all you ever do is just hit those accounts, assets, liability, or equity accounts, then your accounting equation will always be in balance, meaning your debits will always equal your credits. But the moment that you use a revenue or an expense account, your assets no longer equal liabilities and equity, right? And that's what happens. We used revenues or an expense account, so no longer does the balance sheet remain in balance as debit equals credits. So what we have to do is we have to close out all of our revenue and our expense accounts, okay? And we have to move that information up to retained earnings in our equity section. And that revenues less expenses gives us a profit or loss, so we're moving that profit or loss. And when we do that, that brings, and that's represented by this number here, right here. When we do that, that brings our debits equaling our credits for our income statement back in the balance and our balance sheet back in the balance. And when that happens, then we can also create the post-closing trial balance. But we do that by making closing journal entries, okay? We have to make closing journal entries to move the revenue and expense account balances to our retained earnings. So how does this help us? I mean, we're at this adjusted trial balance and I'm saying, oh, we need to create our financial statements. Okay, so you start out with your income statement, right? And the income statement, has revenues and expenses. Well, if you look here, you can see for revenues, I have 7,400 and then 1,100, 1,000, 4, 350, 300. Well, notice that that's what is on our income statement, 7,400, 11,000, 4, 353. By the way, these here figures are in your textbook, so look at Exhibit 3-3 and 3-4. And of course, that gives us a profit of $4,250. So from our adjusted trial balance, yes, we can create our our income statement, and it will be correct. However, if we went and said, okay, let's create the balance sheet, well, you can do the math. I'm not going to do it here, all right? But if you add up your debits and you add up your credits, well, they're going to be off. Your debits are not going to equal your credits, and they're going to be off by this $4,250. Okay, why? Because we haven't moved this $4,250. We haven't moved it to our retained earnings account yet. Okay, that's what closing journal entries are for. Okay? So we can create the income statement. And if we choose to have a statement of retained earnings, we can create the statement of retained earnings. Why? Because we had a beginning balance. Notice it's 9,500, okay, which is what the retained earnings amount is on our adjusted trial balance. But this, remember, the adjusted trial balance is before we make our closing entry. So that retained earnings account, that balance is our beginning balance for our statement of retained earnings. We moved this 4,250, we figured that out from our income statement. And our dividends of 3,200 here is from our adjusted trial balance here. So yeah, we can now create my statement of retained earnings, which gives me $10,550 as an ending retained earnings amount. And at this point in time, we've created two of our financial statements. Okay. Now, if I go back up to my adjusted trial balance here, notice that I had said from our statement of retained earnings, we had a balance of $10,550, right? That was on our retained earnings. But our adjusted trial balance only has $9,500, right? So that's where this is where the what we do is we manipulate the information for our balance sheet. All of the rest of these, we create the balance sheet by utilizing the balances in our accounts, but when it comes to our retained earnings, we're going to plug in this information into our retained earnings account, okay, in order to create the balance sheet. But now realize that, that's the rest of this, all of this other stuff is 95%. We're getting that off of the adjusted trial balance, okay? If you look in the book, you'll see that all of these accounts, all we've done is we've just moved those accounts over here to our balance sheet and have put them in an appropriate place. But the only two accounts that we didn't affect are the dividends and our retained earnings. And remember, the dividends ended up being closed out as part of this 10,550, and we're saying that all of these are also part of that 10,550. So even though our adjusted trial balance looks like this, we can, our balance sheet isn't going to be an exact replica. We're going to adjust the balance sheet accordingly so that we have the right amount of information on it. And then we go and we make our closing journal entries. Okay. I hope you're understanding this. Okay. And let me just kind of go over it from a little bit different perspective. When we're looking at the adjusted trial balance, we're saying that these are the correct balances in the accounts. And we have to use this information in order to create our financial statements. Well, on our income statement, we're going to use our revenues and our expense accounts. Okay. All businesses have an income statement and a balance sheet. They don't have to have a statement of retained earnings. But in order to create the balance sheet, if you're using this adjusted trial balance, what you have to consider is that my beginning retained earnings is 9,500, but I have to adjust it for my dividends account, my revenue account, and my expense accounts. So whatever balances I have here, right, they all have to end up into this retained earnings. So when I do that mentally, I can say, take this debit of 3,200, 1,100, 1,000, 400, 350, 300, and take this credit of 7,400 and add those into this 9,500. So I'm taking whatever the amount of these debits are, and I'm going to add whatever amounts of the credits are, and then of course subtract one from the other and get a new balance of 10,550, which is what I will use in order to create the balance sheet. Okay. Now we're doing that because we haven't made our closing journal entries yet. We're trying to create our balance sheet from this information. We do it this way because now if we go and we make our closing journal entries and we create a post-closing trial balance, the balances on our post-closing trial balance should be the exact same balances as on our balance sheet. Okay, so it's a double check there, right? But notice what I just said. The balances on our post-closing trial balance have the same balances as on our balance sheet. Okay, that's a double check. But we can do this a different way, and it's not the recommended way, but to make it a little easier, I'm going to show you what I'm getting at. So we've created our income statement, and from our income statement, we're able to create the statement of retained earnings. This creating of the statement of retained earnings, like I said, we don't have to have a statement of retained earnings, but we need to think through this process in order to get an ending balance for our retained earnings account in order to be able to create our balance sheet. Okay. Notice that that amount of 10,550 is not the balance on our adjusted trial balance, right? That's because, like I said, we're mentally making the adjustment for closing out all of these other accounts. right? Our dividends, revenues, and expense accounts. We do that through our closing entry. So we know that when we do that, this figure now becomes 10,550, right? Even though it isn't the balance that's actually on the adjusted trial balance. So we've created this here balance sheet and we know it's right. But here's where the double check comes in. We make our closing entries, right? So when we're making our closing entries, we have to close out revenue accounts, expense accounts, and dividends accounts, okay? So remember, revenue accounts have a normal balance of a credit, okay? So when we want to close out our revenue accounts, in other words, let's just use that as an example. We have $7,400 for our revenue, okay? So that's a credit of $7,400. Well, to close it out, we have to do just the opposite. So we're going to make a journal entry as a debit to service our service revenue for $7,400, and that means we credit our retained earnings account for $7,400. When we make that journal entry and we post it to the ledger account, okay, that revenue account that has $7,400 in right now, when we actually post it to that account, well, since that's a credit and we're going to debit it for $7,400, that balance is going to end up being zero. And our retained earnings account will have the additional $7,400 in it because it was a credit. It's going to increase. And we're going to do the same exact thing for our expense accounts. We're going to, since that's a debit of $1,100, well, our closing entry is going to be a credit to, what was that account name? Salary expense. Credit to salary expense for $1,100. And we're going to debit retained earnings for $1,100. Okay. So what you're going to do then, all right, oops, another way. So what ends up happening is that now that salary expense account has a balance of zero, and what was originally $9,500 plus, because that was a credit, plus the $7,400 as a credit, that's 009, there's a credit of 11,900, but now we're going to debit it 1,100, so the balance now goes down to 1,080. And then we do the exact same thing for this rent expense, utility expense, depreciation expense, salary expense, and our dividend. And when we factor in the 3,200, 1,400, 350, 300, we're going to end up with a retained earnings balance of 10,550. Okay, so as part of the closing process, right? Remember, you have an adjusted trial balance at this point in time, which you use to create your financial statements, right? You can create your income statement, your statement of retained earnings, and a balance sheet if you want, okay? But you need to make closing entries. And when you make those closing journal entries, they're journal entries. So you put them in a journal, you post them to your ledger accounts, and you create yourself a new trial balance, which is your post-closing trial balance. Okay. So when you do that, now your trial balance looks like this. Notice that you no longer have dividends, revenue, or expense accounts, okay, because they're all zero, right? And that balance that was in your retained earnings, which was 9,500 before, is now the 10,550, which is what it's supposed to be. Okay. Let me jump up and review that real quick. If you take this dividend account, which is a debit of 3,200, okay, that means you're going, when you when you close out the account, you're reducing it to zero. So that means you're going to credit dividends for 3,200. And because debits have to equal credits, if you make a journal entry for a credit, you have to debit something else. So you're going to end up debiting your retained earnings account. And the same thing with all of these here expense accounts. You're going to credit these accounts, but the debit is going to go to retained earnings. And the opposite is going to happen for this service revenue. This is a credit, so that means we're going to debit that, which means we would end up having to credit the retained earnings. So when we take into consideration all of these figures, okay, that's going to change our retained earnings account to 10,550, right, when you've posted them all to that account, right? So that's why when you've made those journal entries, you post them to the ledger accounts, and then you create yourself a post-closing. Notice the word post, meaning after closing. After you make those closing entries, you create this post-closing trial balance, and these balances now become, these are your ending balances for the period, which now become the beginning balances for the next accounting period. Now, here's the thing, okay? If you look at this, all that's on here is your assets, liability, and equity accounts, right? And notice that your retained earnings account is 10,550, okay? Which is exactly what your balance sheet should look like, okay? So it begs the question of, well, if I'm up here and I'm using my adjusted trial balance, and I take my adjusted trial balance and I say, okay, it's time for me to create my financial statements. I can create my income statement from, excuse me, from my adjusted trial balance, because all I'm concerned with is my revenue and my expense accounts. So I could create the income statement. I can create a statement of retained earnings because I could all I'm concerned about is the profit and loss and the dividends account, which comes from my adjusted trial balance. But I can now deviate. I can go a different way and say, okay, well, once I make those two statements, why not do my closing entries and post them to the ledger accounts? Because when I do, okay, everything will be closed out properly to my retained earnings account, okay, and I'll have a post-closing trial balance that I can use to create my balance sheet, okay, because when I use all of these accounts, that's what I have on my balance sheet, right? I have all of, here's my assets, here's my liability, and most importantly, that's what my retained earnings looks like from my post-closing trial balance. So I can use my post-closing trial balance to create my balance sheet. Now, this is an alternative way of doing it, and it's not the preferable way. I mean, it makes it easier for people who are new to accounting, because it's easy to see that when I have my adjusted trial balance, I can easily take the numbers for my income statement, and I could take the number to create my statement of retained earnings, but I don't have to do any mental gyrations in order to adjust my retained earnings account in order to create the balance sheet. Right? That's the way you're supposed to do it. You do the mental gyrations because you're going to create your closing entries, and you're going to give it to the bookkeeper, and the bookkeeper is going to enter it into the system and create a post-closing trial balance. What if they enter it in wrong? Okay, if they enter it in wrong, maybe this here post-closing trial balance has a retained earnings amount of, say, 10,150, right? Well, you're saying, if you created the balance sheet doing the mental gyrations, you're saying it should have 10,550. Okay, well, that's your double check in order to make sure that your information is correct. If you had gone and given the entries to the bookkeeper and they entered it in wrong, and you go and you create the balance sheet from the post-closing trial balance, you're going to have an error on it because your retained earnings will be 10,150. It won't be correct. Okay, so just be aware that, I mean, if you're doing your work correctly, it really doesn't matter if you create the balance sheet from the post-closing trial balance, okay? Because you did the work, correctly, and there is no error, right? But you're circumventing, you're bypassing the possibility of making that error. When you do that, you don't have the double check that allows you to be able to know. Because remember, more than one person, or if you're doing it yourself, you're treating yourself as a bookkeeper and the accountant. Okay, so you have your adjusted trial balance, you create your financial statements. As an accountant, you make the closing entries, all right, and you give them to your bookkeeper, right? So you've created your income statement, your retained earnings, and your balance sheet, and you're doing the mental math in order to make sure your balance sheet is correct. And when you give those closing entries to the bookkeeper is going to enter those journal entries. They're going to post to the general ledger accounts. They're going to create new balances, and they're going to create a post closing trial balance. And when they hand you the post closing trial balance, it should match what you have on your balance sheet, and that's your double check. Okay, but if you went and said, okay, I'm going to create my income statement, retained earnings, and I'm not going to do my balance sheet, and I'm going to give the closing entries to the bookkeeper, well, it is possible the bookkeeper might make a mistake. Okay, and when you get this, there's a mistake on this post-closing trial balance, and then you're going to try to create the balance sheet with that mistake on it, and it's not correct, right? So I realize that this is a little convoluted and it's a little bit hard to understand, but the process in going through all of this, let me jump all the way back up from the high level view, is that we're here at step number 6, okay, and it says prepare financial statements, meaning you create the income statement, you create your statement of retained earnings if you want it, and you create your balance sheet. And you're creating it off the adjusted trial balance, but realizing that your retained earnings account is not going to be right, okay, at this point in time, because you haven't made the closing entries. You're going to create the balance sheet so that it is correct. And when you do, then you can make the closing entries and give them to your bookkeeper, who then creates a post-closing trial balance. And that post-closing trial balance, the information should be the exact same thing that you have on your balance sheet. And that way you know that your post-closing trial balance is correct and your balance sheet is correct. And then your post-closing trial balance will be the beginning balances for your next accounting period, and you start the entire process all over again with step number 1. Okay? So, with that said, realize that we're talking about bookkeepers versus accountants here, okay? And if you watch the introductory videos, you'll understand why there's a separation between the two. At one point in time, they taught accountants how to be very, very good bookkeepers, but with the advent of computers and having to learn additional skills and things like this, the educational bodies decided that they just give a quick 1, 2, or 3 chapters on bookkeeping, okay? Because bookkeepers keep the books, okay? Accountants, their job is not to do data entry, right? It's all one language. Accounting is all one language, and it's the books of accounting. So both bookkeepers and accountants need to know that language, right? But the data entry is done by the bookkeepers, and the analysis is done by the accountants. Okay, so everything doesn't. For bookkeepers, they're not the end-all be-all of everything, okay? Yeah, they do the data entry, but it's up to the accountant to make sure that everything is correct, right? I mean, it doesn't, that doesn't negate the fact that the bookkeepers should be doing their work accurately, and like they shouldn't care. I mean, if you're making too many mistakes, that costs money, okay? And as a bookkeeper, and they'll get rid of you, okay, and find somebody who's more capable, and more accurate, and able to do the work, correctly, right? But the bookkeepers do all of the data entry, and then the accountants take that information and they do the analysis of it. Now, when it comes to financial accounting here, and notice I put a 40,000 foot view here. Going forward from chapter 4 on, okay, we're still looking at accounting from a 40,000 foot view, okay. We're going to start getting into more of the little bit nitpicky details like I had alluded to, like depreciation, okay. In chapter 8, there's 4 different, it's going to present 4 different methods, okay. So what you're doing is you're taking one specific account, the depreciation expense account, and we're going to, or accumulate depreciation, and we're going to look at those methods specifically. So from chapter 4 on, we're getting more into a little bit more of the detail, but realize that you're still at you're still at an introductory high level view in financial accounting. You're not into intermediate or advanced accounting yet, okay? So it's like peeling an onion, every time you peel an onion, you get deeper and deeper, or going down the rabbit hole, every time you pass a milestone, you look down and can, keep on going. So where you're at right now, in chapter 3, theory-wise, we've kind of covered everything as far as bookkeeping is concerned and getting the basic language of accounting down. Rewatch these videos for chapter 1, 2, and 3. Definitely do the homework problems. Accounting is about application, understanding and application. You'll understand more the more you do. You can't just read and expect to know it. It's not American history. And also, too, take advantage of the other videos that were created previously. Take advantage of the YouTube videos by Matt Fisher, to try to help you understand the material. And, being it's a video, you can watch it again and again and again. And if you still don't understand something, feel free to telephone and speak with an instructor who will try to help clarify it. So with that, this is 32 minutes, and I hope the video doesn't crash. I'm going to end here, and we'll pick up in the next set of videos actually doing the homework problems for chapter 3, the assigned exercises and problems from group B. So again, if you don't understand something, feel free to give us a call. Okay, thanks, and we'll see you then.